India just killed a 65-year-old law, and starting today, April 1st, 2026, the way you earn, save, and pay taxes in this country has fundamentally changed. But here's the thing, most people are getting wrong. This isn't really about paying more or less tax. It's about something much bigger. Alright, so let's set the stage. The Income Tax Act of 1961, the law that has governed how every single Indian pays taxes, has officially been replaced by the Income Tax Act of 2025. We're talking about a law that was patched, repatched, amended, and duct taped over 4,000 times across 6 decades. It had become so bloated and complex that even a chartered accountant needed chartered accountants to interpret it. So the government said, enough, we're starting fresh. The massive 819 section, 47 chapter old law has been condensed into 536 section statute with clearer language and a more logical structure. The rulebook slashed from 500 rules to just 330. Now, and this is important, your actual tax rates, your slabs, they haven't changed. Income up to 12 lakh rupees is still effectively tax-free under the new regime. So no, the government isn't sneaking in higher taxes under a fancy new name. The goal here is simplification. Think of it like this. They didn't rewrite the recipe. They just reorganized a very messy kitchen. Alright, now here is a change that honestly should have happened decades ago. Raise your hands if you've ever been confused by the difference between financial year and assessment year. Yeah, you, me, your CA uncle, everyone. The new law scraps both terms entirely and replaces them with one single concept, the tax year. So from now on, tax year 2026-27 runs from April 1st, 2026 to March 31st, 2027. And you earn and file within that same period. No more mental gymnastics. No more filing your assessment year 2027-28 return for income earned in financial year 26-27. Your Form 16, which is now called Form 130. By the way, we'll just say tax year 26-27. Clean, logical, done. Now, look, this might seem like just a label change, but from a compliance standpoint, this is a massive thing. It aligns India's system closer to global standards, which matters a lot for businesses and NRIs dealing with tax systems across multiple countries. But here's where it gets interesting for your wallet specifically, because while the rates didn't change, the structure of your salary absolutely did. And this is the part nobody's talking about. Let's talk about HRA first. House rent allowance. If you live in a city like, say, Bangalore, Pune, Hyderabad, or Ahmedabad, and you're claiming HRA under the old regime, you just got a significant upgrade. These cities now qualify for the higher 50% HRA exemption, putting them on par with traditional metros like Mumbai and Chennai. That's real money back in your pocket if you're renting. But, and this is a big but, the rules are now stricter. You need to provide your landlord's PAN and proof of rent payments. In some cases, full landlord details are mandatory. So if you've been, let's say, creative with your rent receipts, that era is now over. Now for parents, this is a game changer. Children's education allowance jumped from 100 rupees per month to 3,000 rupees per month per child. Hostel allowance from 300 rupees to 9,000 rupees per month. Those old numbers were set decades ago and probably they made sense. The new numbers, at least, they try to reflect what education actually costs today. And a quick one for those of you swiping meal cards at lunch. The tax-free limit on meal vouchers has gone up from 50 rupees per meal to 200 rupees per meal. Over a year, that adds up. So the quick question for you in the comments, are you on the old regime or the new regime? And after hearing all this, are you thinking about switching? Drop in below, because I'm genuinely curious. Now here's a sleeper change that might actually hit your bank account the hardest this month. Under the Code of Wages, Your basic salary plus DA now has to be at least 50% of your total CTC. For years, companies kept basic pay artificially low to minimize their PF and gratuity contributions. That workaround is now gone. So what does this mean practically? Your PF contributions go up, your gratuity payout increase, but your monthly take-home salary might actually take a slight dip. Before you panic, this is a short-term pinch for a long-term gain. You're essentially being forced to save more for retirement. Your future self will thank you for your present self. And for anyone switching jobs, companies now will have to complete your final settlement faster. So no more chasing HR for 3 months to get your last paycheck. All right, let's talk about the stock market crowd for a second. If you're trading futures and options, brace yourself. The securities transaction tax on F&O has been hiked. This directly increases the cost of every derivatives trade you make. If you're an active F&O trader, this is going to chip away at your margins trade by trade. And here's another one for dividend investors. You can no longer deduct interest expenses against your dividend income. So if you've been borrowing money to invest in high dividend stocks, your taxable income on those dividends just went up. From a geopolitical and macro lens, which is what we do here on Nelson John 360, this tells you something about the government's direction. They're clearly discouraging speculative F&O activity and nudging people toward more long-term, stable investing. Whether you agree with that philosophy or not, that's just a signal. So let's bring it all together. What happened today on April 1st, 2026? This isn't just a rule change, it's a system change. Last year's reforms were about giving you tax relief. This year's reforms are about redesigning the entire framework. How income is defined, reported, and verified. Your tax burden probably isn't changing much, but the way you interact with the tax system, that changed completely today. Here's my advice. Talk to your CA, revisit whether the old or new regime makes more sense for you now, especially with the bumped up allowances under the old regime. And if you're filing your own taxes, don't worry. The new e-filing portal supports both acts during this transition period. If this breakdown helped you make sense of what just changed, smash that subscribe button, because Nelson John 360, we break down the stories that affect your money, your career, your future. No jargons, no fluff. I'll see you in the next one.